Welcome back to the Mortgage Update with Dan Frio, and thank you for coming back. What we're going to talk about now is, I guess I'll reference it as the new SubPrime. Please don't turn off the dial. There is reasons why these programs can help many, many, many people out there. So let me go back for a second and let's talk about SubPrime for a minute. And I'm not going to waste a lot of your time on this, but let me tell you what happened in the past. My name is Dan Frio, the Mortgage Update. You hear me every day on AM 1160 commercials, things like that. I'm also live with Mark Elfstrom every day at 5:20 p.m. So tune in. It's basically a 2-minute conversation with Mark that he asked me a question that he might hear from listeners and things like that, and I answer. So let's go back to subprime loans. Yes, they were a huge piece of the puzzle that crashed the economy. I won't go through how, why, and where it all happened, but basically subprime was created to help a lot of people, and it was with good intent. It was either you took out a conventional or a standard mortgage at 20% down, with all these restricted guidelines, or you're stuck. There was nothing. Or you could go to a high finance company or basically a money shark and get monies at whatever terms they wanted to give you. So thus the creation of subprime mortgages. They were saying, and they were intended for good purposes. They were like, you have to have good credit, but there was just reasons why you fell outside the box. Then what happened is it just got crazy. And then, the government comes out and says, because the economy's cooking along, everybody needs to own a home. Well, I hate to say it, but everybody doesn't need to own a home. Thus creating, and the greed of a lot of people that created some of these vehicles, it started to get really out of whack. Basically, the joke in the industry was, well, if you have a heartbeat, you can get a loan, because there was these qualifications that if you had a 580 credit score and some equity in your home, you could suck out that equity. Basically, if you didn't have a job, well, you would just state on the application how much money that person possibly made. So you could say, I get Social Security and I make $10,000 a month. It went through. I lived it. I saw it. So that was, the creation of this then went south, and then everything blew up. So now, with the economy stabilizing, home values stabilizing, things kind of getting back on track, there's still a cluster of a group of people. They're having a tough time getting financing. And a lot of that is because of, a lot of the tax laws. You can write off things. You can depreciate things. You can, you're writing off interest. You're writing off depreciation. You're writing off cost of goods sold. You're writing off, insurances, payroll, cars, cell phones, this and that. So you're taking advantage of the tax laws. However, when you go to apply for a loan, they look at, well, your gross income was, $500,000, and your net, you brought home $8,000. Thus the creation of some of these programs. Now what they're called, instead of being called subprime, they're called non-QM, non-qualified mortgages. And I won't go over that, the reasoning behind that. You might want to Google it, just non-QMs. So here's the programs that are coming out. They're coming out slowly, but I feel in this case, there's good intention here. They've kind of raised the bar on a lot of areas. They did their due diligence. They don't want a repeat of what happened, 10, 12 years ago. Do I feel it's going to happen again? Probably. Unfortunately, greed doesn't learn from the past. So, it is what it is. But let's go through some of the programs that that could possibly qualify you for, if, kind of programs outside the box. And here's what I mean. There are bank statement programs. And so what this is usually intended for are people that are self-employed. You might not be self-employed, or, for example, Uber driver. There's a lot of Uber drivers. There's a lot of clients that call me that, they do side jobs, things like that. Should they, put that income on their tax returns? Yeah, maybe they do. But maybe they write off so much stuff that, again, they made $500,000, but then it netted them $8,000. So thus created the the bank statement program. So we get business bank statements. You can, in some situations, get personal bank statements. The credit scores, though, and I'll go through those with you here in a second. Credit scores start at a minimum of 580. Okay, but there's a lot of restrictions to that. It's 24 months of bank statements. So what happens is your deposits get averaged, and then for all that time period, but some out of the ordinary deposits get taken out. So like if you get a tax refund, that gets taken out. If you return an item that you purchased, that gets taken out. That's not income. So they really kind of wash through your bank statements to get things that were income. And that thus creates 24 months bank statements. We add up all the deposits for 24 months, divided by 24. That's your income. Then it boosts up to a 660 credit score. That will give you a higher loan to value. Let me backtrack for a second. That 580 credit score with 24 months bank statements, you can go up to 85% of the home's value to purchase or refinance. Okay, at 580. At a 660 credit report or credit score, you can go same 24 months, but you can go to 90%, 90% to buy or refinance your home. Now let's get up to higher credit tiers. 680 credit tier. You can go to an 80% loan to value with 12 months of bank statements. So you're going to say, well, Dan, at 580, I can go 85. Yeah, that's using 24 months. Let's say last year, income wasn't as good as this year. So now we switch it and we say, okay, well, your credit score is phenomenal, but last year kind of killed you. You started a business 2-3 years ago. It's now taking off. So now we can use 12 months bank statements. If you have a 700 credit score, you can go even higher than that. So those are areas for bank statements. Here's the program that I really, really like for consumers, but I hope it doesn't get overblown. There is an investor program. So if you have a rental property and you wash out, meaning you deduct a ton of things from your income. So basically that rental property is crushing you because you had a fire last year, the taxes are high, things like that. You could qualify with a rental analysis. So there's two things involved in this. Let me go back to here's how you qualify. With a 620 credit score, as long as the property supports itself, meaning the rents support the mortgage payment, you would qualify. So you're going to say, well, that's an easy fix. I'll just rewrite my leases. No, it doesn't work that way. What happens is we get your leases, and then when the appraisal is done, the appraiser does a rental analysis and gives us the rents for your units by asking you and the tenants, and then also does a market analysis to make sure that supports what you're stating. So if it doesn't support, they're going to use the lower of that value. So you can go with a 620 credit score. You can go up to 80% of the home's value to purchase or refinance. Awesome. This should help. This program should help a ton of investors either buy properties or refinance those properties to get better terms. Because a lot of times you might have took out basically a land shark loan, and it might be really bad terms, and you can refinance it with this, or it can help you add to your portfolio of rental properties. And then there are programs that allow you to get a mortgage for 1 day out of foreclosure, 1 day out of bankruptcy, some credit lates. But they basically, there's a lot behind that. The loan to value gets reduced dramatically, but it's helping people. Let's say you have, you owe $50,000 on a $200,000 home, and you need some money, and you have a 550 credit score. There's no program really out there a lot of times to help you. This program might help you patch up everything and get back on track. And then a year or two later, I call them Band-Aid loans. We put the Band-Aid on it, let it heal for a year or so, and then go back in and restructure that into a much better loan. So Like I end every other show, I'm going to talk to you about creditscoresandmore.com. It's a website that's people can use basically to do it yourself. Get your credit scores, get credit monitoring, get credit advice. Step one will give you a free credit system. I highly urge everybody to do that. Step two is let's go over this section, and every day I'm going to pick a little section in there to talk about. Section two, or step two, is getting, I reference it as your true credit scores. What's your true credit score? Well, it's not Credit Karma. It's not a lot of those credit scores out there. Those are what they call Vantage scores. They're basically educational scores. Your true credit score will actually pull your scores from TransUnion, Equifax, and Experian and actually give you the real scores, the actual scores that your lenders will use. And what I mean by lenders or your creditors or so forth is your mortgage company, if you're trying to refinance, your insurance, and your insurance companies pull this. And the better your credit, the better your premiums. Car loans, credit cards. So I urge you to go to creditscoresandmore.com. Check it out. Also, I want to thank you so much for listening. You can reach me. I'm Dan Frio, 630-338-1160. Please check me out on the web. It's 1160-mortgage.com. Also check me out on YouTube. So just Google Dan Frio and you'll find me all over the web. Thank you again so much for listening. I hope you have a wonderful evening. God bless. Please come back tomorrow.
You've been listening to The Mortgage Update with Dan Frio. For over 10 years, Dan has been helping AM 1160 listeners. With so many companies to choose from and hundreds of loan options, the mortgage process can be confusing and costly. Be sure to listen each day for Dan and learn the difference between FHA, VA, and conventional loans. You'll also learn how to negotiate lower interest rates and fees, as well as steps to buying your first home and whether refinancing makes sense.